Ripple effects from Evergrande. So in today's real estate update, we want to start with where the bomb is going off and where the contagion is going to be spreading, not just in China, but over here across the Pacific, back home in the United States. We are definitely going to be feeling this. And all I have to say is, may God be with those that thought that Evergrande was a big nothing burger and everything's going to be A-okay. In this episode, I'm not going to talk about how Evergrande could have implications for the digital asset space, but it very well could. We know that Tether has been one of the biggest buyers of commercial debt and commercial paper, the Evergrande bonds. They've said that they've, denied any access, or I guess investment would be the proper word, into Evergrande, but that has not been confirmed, and we still have never gotten that Tether audit. That's all they have to do, is provide a legitimate third-party audit, and that would subside all of our fears and worries and concerns. But while we wait for that to be done, we are going to see the impacts felt here in the real estate market as well. And so let's highlight why this is such a big problem, and then I'm going to give you guys some more data points on the real estate reset here in the United States. So starting off here, let's get into it. Why Evergrande matters. And now, so many people thought this was a big nothing burger, but in fact, the bankruptcy process was still just going on. And now the largest shareholders have agreed, or basically are pushing for it to be liquidated now here at the end of the month. So Evergrande, and this is data as of June 2023, owns land reserves of 0.19 billion square meters, involved in 78 urban redevelopment projects, including 55 in the Greater Bay Area. 30, that's San Francisco, right? 34 in Shenzhen and 23 in other cities. Total liabilities amounted to basically 332 billion US, okay? 2 trillion RMB, but it's equivalent to 332 billion US per Google Finance. Total borrowings amounted to 86 billion, 2,229 pending litigation cases, 109,000 employees. This is employees losing their jobs, massive layoffs. This is obviously lots of assets that have to be sold off. This liquidation process is going to take a while. And once again, this is not a big nothing burger like many people are suggesting, right? Properties in under development expected to be completed is about 151 billion. Okay, so they're still pushing, and these are projects that are unfinished. Okay, the ordered liquidation of China Evergrande Group is going to have a significant implications on the Chinese real estate sector, its overall economy, as well as foreign economies as well. And that's what we're going to be talking about, foreign economies. We're going to be talking about the situation back home. And what we're going to see, which is just a lack of liquidity coming from foreign investors into markets up in my neck of the woods, like Vancouver, Seattle, all the way down to the Bay Area, other big cities as well. Obviously, many cities where these investors, and you got to look at who are the biggest holders. You got BlackRock, you got some of the other biggest players in Wall Street that had exposure and were some of the biggest investors in Evergrande as well. So the ripple effects are going to be felt in many different sectors. We're talking layoffs. We're talking, liquidation of assets. We're talking about projects that aren't completed. And so we're just beginning to really crack this thing open. Even though the process started a couple years ago, now it's starting to accelerate, and now it's coming back top of mind for many folks. Let's combine this with the data points that we're getting back here in the United States. And this is why I say it's going to be one heck of a real estate reset, is we have, ripple effects coming from Evergrande and from foreign markets that are already in the tank. Remember, China's stock market's already down about 40-50%. Now let's combine this with the domestic data, which is also not pretty either. First point here from Don Johnson: Nevada's labor market continues to be on the verge of recession. Right here, the black marker, the black line, is our current cycle for jobless claims in Nevada. And you can see the past cycles. And Nevada is one of those boom and bust cities that is a leading indicator of our economy entering recession and of real estate reset. It's going to be ground zero for this real estate reset. Now, speaking of resetting of prices, I'm not just talking about this. This isn't just how I feel. Many people see me as a millennial that doesn't own a home and think that I just want cheaper prices. No, I'm just looking at the data, and that's what I'm here to report, is the data. And the data is telling us very simply, we have the fastest falling home prices since 2022. And we're looking at Austin down 16.3%, New Orleans down 11%, Boise down 10.9%, San Francisco down 9.5%, Reno 7.5%, and that's Nevada, right? We just highlighted how that state in trouble. And we'll see Vegas obviously going to be in trouble there as well, too. Provo, Utah, 7%, Sacramento, California, and Santa Cruz down 6.8 to 6.7, Seattle, Washington, 6.6. And we already see Phoenix, Arizona down 6.6%. And I was just in Phoenix, boots on the ground, collecting data from the streets on the real estate reset in the Phoenix metro. And it is happening there, with the national home builders putting special financing available on top of all of their signs, offering all the incentives that they can, and they're stuffing in thousands of homes out into no man's land, into the desert, and that Phoenix metro just continues to expand. But as we highlight right here, prices already down 6.6%, and I don't even know if that's from the peak or if that's just from 2022, but nonetheless, prices in free fall. Now, we look at the office space. This is one of the sectors, the segments of real estate that is getting sacrificed. It's not just, oh, we're down 10, 20%. I use the term sacrifice because of these data points right here. 14% of all commercial real estate loans and 44% of office building loans are now in negative equity. Get that, folks. 44% of office building loans are now in negative equity. In other words, the debt is now greater than the property value on all of these properties. Currently, U.S. banks hold over $2.9 trillion of CRE debt, the majority of which is held by regional banks. Office buildings prices are down 40% from their highs, and commercial real estate as a whole is down over 20%. So, commercial real estate is in a crash, is in a bear market by the technical definition of a 20% move down. Office is twice as bad. And as I've been reporting, these banks have $684 billion of unrealized losses on their bonds. And I've been throwing out there that they have about $1.5 to $2 trillion of commercial real estate that's also in delinquent, default, or in negative equity. The total commercial real estate debt that they have is 2.9. We're going to get to find out how much of that they get to reset, restructure, and if they can find anybody to buy it. But when you have the largest property developers in China going down, the ripple effect's going to be coming back over here. It's going to be very interesting to see who's going to buy, show up to buy that. Now, one of the opportunities, where can we make money investing in real estate, you ask me? Well, one of the opportunities that we've talked about is office space conversion. But the problem is, I've done more studying on this now. The studies say that there's only about 5 to maybe 10% of office buildings in their current state that are actually viable for conversion from office space to some sort of apartment shared living area, multifamily housing. So, I've talked about how I think that commercial conversion could be a tremendous opportunity, but it's few and far between. You really got to find, we're talking about 5 to 10% of office buildings that would be viable. There are already some big companies that have started to try doing this, and they're hollowing out the cores of these office buildings so that you can get more light in. Like they're literally like taking out the center of these office buildings so that, you can get light coming inside and you have more of a livable area. So you're talking about serious renovations and construction, which obviously is going to affect your bottom line. If in converting the property, you're spending millions of dollars to hollow out the core and make it into livable apartments, it's a tough deal to swing. And at the same time here, we're seeing that office vacancies have now hit a new record high in the U.S. So, I just am generally saying that we're in a real estate reset, but some of these data points are the worst that we've ever seen. Now, on an overall scale, generally speaking, is this real estate crash going to be worse than the great financial crisis? That's debatable. I could talk about that for a lot longer, but I'm just here to present the data. It's up to you guys to figure out how to invest accordingly. And I hope that everybody is thinking about this real estate asset class because we all need a roof over our head. And speaking of opportunities, the good news is that some of these markets are about to get flooded with supply. They are going to be oversupplied. Not necessarily, this is a key point, not necessarily oversupplied on single family houses. There's still a shortage of single family homes in many of the most popular suburbs across the United States. But there will not be a shortage of units. As apartments and multifamily get thrown up, we are going to see, I think some of these markets are going to get flooded with units. Not necessarily single family housing, but townhomes, apartments, multifamily units. And one of those markets that we're looking at right here is Nashville. Over 16,000 apartments are vacant in Nashville, equating to an 11% vacancy rate, and the construction pipeline is booming with 37,000 new units coming available this year. So multifamily housing apartment construction is at an all-time high right now. So we're about to get flooded, and there's reports now of landlords in Nashville that are offering 3 and even 4 months rent free when you move in. So we have an opportunity right now to move in on the builders who are offering all sorts of incentives and deals to get you in the new home. Just make sure that you have a third-party home inspector check their construction quality, because we're starting to see a lot of stories coming out of crap being thrown up, which is my biggest concern with new housing. But get an inspector, make sure it's done properly, and go wheel and deal with the builders. And then the other one is watch for markets like this, where they're getting flooded with apartments. For those of you that are going to sit this out or just continue to rent, now's a great time. Your landlord, you might be paying too much right now. Your lease is coming up this year. It's time to negotiate, right? These landlords have gotten away with 3 months rent, a security deposit, charging you $100 for your dog, $100 for your cat, $100 for every adult over 18, $100 if it rains. I'm being dramatic, but literally, they've been able to take advantage of the lack of units available, the lack of housing, and they've taken advantage of this, and they've really ran it up with all the fees and raising rents. Now rents are starting to fall off. Go negotiate your rent, your lease, and get yourself a deal. Same thing with the builders. And one other thing that we want to show right here is that the volume here is falling off for the overall space and for existing sales as well. So now is your time to go negotiate with everyone. Finally, for the first time in a few years, buyers are starting to have a little bit more leverage. Existing home sales have experienced a sharp contraction 3 times in the past 55 years, and all were similar in magnitude. People look back to 2006 and through 2009 and declare, here we go again. I think that's a big mistake, because that period was very different from the other two. And the other two, right? Great financial crisis, and then also in the beginning, 1980 as well. Now, why is this time different? New home sales also contracted each time, as well as a couple others. 2009 was by far the worst in both severity and duration. The current period is by far the least severe. So are we just getting started? Have we already bottomed? We're going to start to recover. And I think that this is going to start to pick up, because more units are going to come online. Which, what does that mean for prices? Well, prices will have pressure to the downside. As the market gets flooded with more listings, that's going to bring, and more units get brought online, that's going to bring prices down. Okay. A 2.5 point rise in mortgage rates in the early 70s caused a bigger decline than a 5-point rise this time. Okay. So it is a little bit different this time. Why have new home sales held up so much better today? I think data suggests it is because our inventory problem is so much more severe than it has ever been in the past. And that's the ticket. Some of these markets still have a shortage, which is why the prices have not dropped as much as they have in the past. Some markets, prices are still going up, as a matter of fact. Higher rates pushed inventories up near average levels in the 1970s. This time they have not moved. So people have the golden handcuffs, and they can't afford to give up their current rates at 2, 3, 4%. And move into a new house and run it up run up that mortgage payment, now paying, 6-7%. The other thing that we want to watch for is in where you're going to see opportunity is in cities that are banning short-term rentals or making it more difficult to do short-term rentals. We're now starting to see the stories come out of Airbnb investors who aren't turning a profit anymore. Now they're losing money. And the other problem that we're seeing is that cities like Dallas are banning short-term rentals completely. Other cities are implementing strict standards. They're limiting the amounts. And that's the same thing that we're seeing right now in Palm Springs. Palm Springs home values in free fall after city cracks down on Airbnb. Now, for these markets, it might take a long ways to go before you really get to affordability, because the investors in these markets bid these properties up where they were selling based off of the cash flow that they could generate from an Airbnb. Now they can't Airbnb anymore. Some of these cities, what they're doing is they're saying only one Airbnb within your block. I mean, they're doing all sorts of restrictions. And if you weren't grandfathered in, no more Airbnbs within the mile radius. I mean, there's all sorts of deals that these cities and local towns are doing. And when they're doing this, this is obviously going to bring more pressure, more units brought online as long-term rentals, and more listings brought online as investors just offload the properties completely. And this is the opportunity for you and for me. Whether you're just looking to buy your first property or whether you're looking to build your real estate investment portfolio, I believe that we're going to start to see the buyers have a little bit more leverage. Investors have been caught with their pants down. They're going to have to reset their portfolios. Obviously, 2.9 commercial real estate held by the banks in the United States on top of the $684 billion of bonds. It's a bad balance sheet problem that we have with the biggest banks in the US. And so it's time to reset it all the way from the top down. This is your opportunity. Lean into the chaos and bring order to it. As we've been saying, set your intentions, control your energy, and bring order to the chaos. This is our opportunity. This is our time. Let me know in the comments down below what deals you're going to be making as far as the real estate asset class in 2024. I'm really interested. Drop a comment down below. And as always, I appreciate you guys for stopping by. If you appreciate the update, please like this video. Everything can be found on my website, ZachRector.com. And I will see you guys in the next one. Take care. Thank you so much.